welcome to our first video here on Stonekeep Trading's channel. I'm going to be diving into a few of our algorithms today just to give a better explanation verbally to our users here on basically some fundamentals of them and a few ways you can look to use them. So the scripts I'm going to be getting into are the market segment shifts, the multi-time frame segment shifts, and the high risk zones plus added risk signals. So to start us off, we're just going to look at our market segment shifts here. So some fundamentals surrounding this, which is really key to understand here, is that there's 3 periods of analysis going on here. And what I mean by that is a base level kind of condition that this algorithm starts with is it looks at its regression lines, because we're regressing price here on 3 different periods. So we have our longest period here, then we have our middle period here, and our shortest one right here. So the reason we do this is because these all offer different levels of insight into the shorter or longer term directional movements. So one thing that's key to understand here is the signals in which time frame, or not time frame, but period they actually correlate to. So when you see a big red or big green label, these are in correlation to the longest regression period right here. So the base condition that it starts with for these is for any bearish movement, it will have to be below this regression, and then for any bullish movement, it will have to be above. Now it uses the same assumption as the starting kind of condition before it goes into all its statistical and data analysis, which is behind the true fundamentals of this algorithm. But it does this for all these different periods here. So you can see once price gets below here, we get this bearish signal. Now obviously this is a false signal because price just reversed right back. And I'll go into some ways how you can kind of detect these better with our other tools that we provide. But you can see here these tinier labels. You can see a green one there and a red one right here. Now these correspond to the middle period regression, right? So there will be times where the long period and the middle period will print their shift signals at the same time. This is a common thing. But there are a lot of times also where they don't. So you can see right here, you can see right here, right? And then again right here, you can see they print at the same time. Now this doesn't necessarily insinuate anything on its own, but it's something to be aware of just for your own knowledge. Now, one other key thing that's important to understand is that the shortest period does not have any shift signals which correspond to it. And this is because the shortest period was added as an option in our last update. You can see we can turn this off right here, and that will go away. See, there you go. So the reason this was added was because without it, price tends to, I'll show you again without it. So without this, you can see that if you were to be in a long anywhere within this segment right here, you don't have as much insight into these really short-term pullbacks or price movements that are occurring. And the reason you want to have these is for either trim points or exits, or just to be knowledgeable. You want the biggest picture you can get to make the clearest decision. So turning this back on, this is really meant to be used for, like I said, either trim points or exits. Could even be used for tinier scalps. It's really just dependent on your own level of risk and your own trading style and how you like to structure the trades, right? Now, another thing I want to get into is different things you can look at that kind of vary within different kinds of shifts. So the strongest type of shift, which will have the highest probability of yielding return, they occur at or near crossovers of these regression lines, right? So you can see right here, crossovers or unders. Let me clarify that. So you can see right here, the middle period and the shortest period both cross under the longest period. As this longest period bearish signal has printed off, right? And you can also just see in the overall price structure, we have a lower high right here, lower low. It looks like price might be coming down. Now, additionally, you can see right here, price is floating between these lines here. but the regressions themselves don't look like they're crossing over or that they're heading to cross over yet. So being mindful of this, it's not a bad idea to necessarily sometimes start positions upon either the middle period's signals, or just as the regressions maybe aren't crossing over or under. You can look to scalp, you can look to start a position, you can look to do a lot of things, but it's something you need to be mindful of in terms of the positioning of the different regressions and kind of what those are indicating. So again, right here, we can look at this bullish segment shift right here, where we have the longest period and the middle period both print a bullish shift signal at the same time. And given all this mess that's happening right here, I might be a little wary of just grabbing an entry right here. But at the same time, if you just do a simple risk to reward here. So, and I'll get into this with the high risk zones because this is the whole purpose of these, following this. But you can look here that your risk would fall anywhere from here to here. You would not want to see price drop below these lines because then it has the possibility to flip to a bearish segment. Now, I don't know where your take profits or whatnot would lie, but clearly there's a decent risk to reward here within this segment. However, you can look to see that maybe you'd want these regressions to cross over first. So you might not take the signal given all this mess that's happened back here. And then you might wait at this signal, right? Regressions have crossed here. And you can see that we get this bullish signal right here. Now, next I'm going to go talk about the multi-time frame segment shifts. Each kind of additional tool that we put out, it's all meant to be used in combination with each other, and they all kind of cover a different aspect of important factors which go into the success or failure of a trader, right? So our first one is just the market segment shifts. This is to just give a general kind of idea of where the market's heading. And fundamentally how it's made is that it can't miss any sort of market move, right? If the price is going down, fundamentally it will catch that as a bearish segment shift. If it's going up, fundamentally it will catch it as a bullish segment shift. It can't miss those. So what you get is basically just a very kind of clear, less noisy, rather than if you turn this off and you're just looking at candles here. I mean, trying to decipher what's going on here becomes a lot harder. But when we have this, and I like to keep my candles off, and when we turn the high risk zones on, we now have these gray candles here, but I'll get to that in a second. When we're just looking at the multi-time frame shifts now, the whole purpose of this is to be able to, without flipping between all these different time frames, you can see the overall picture of the market, right? You can see time frame shifting in real time without actually having to go to the chart, because some of our tools, they do take longer to load up, and it gets very tedious when you're trying to make a quick judgment call, waiting 30 seconds for one of these things to load up. So you really don't have to. You can sit here and you can watch the segment shift as they do. And ideally what you're looking for is every large move will start with a 1 minute shift, and then it'll develop to a 5, 15, so on and so forth, right? Now it won't always be this clean. A lot of the times you might have some higher time frames are already bearish, right? And you're bullish on some lower ones, and then these flip back over. A lot of things can happen, and as you use them, as you use this, you will see that yourself. However, some great insight can be derived from this in terms of just kind of judging the overall market sentiment and which direction it might be headed for, shorter terms or longer terms, depending on what you're trying to look at. So what I'll do here is I'll put this in replay mode, starting from the end of this bullish shift over here, this bullish segment. And you're going to see how these time frames all develop their segments into much more bearish, obviously. All right, we're going to start from right here. So now that we're in bar replay mode, and we have our multi-time frame segments loaded up here, as well as our market segments loaded up right here, you can see that this is very bullish. We're coming on this very strong bullish trend and this very bullish segment right here. And now as I play this, what you're going to see is you're going to see these develop down to a bearish time frame to where we currently are now. So let's watch that happen. So you can see we get a 1 minute shift there, 5 minutes starting to shift over, 5:15. This is the short term, this is the long term. right? We get this 4-hour long-term actually looking bearish now. And all these just flipped over. And boom, now these are all red. We're going to see the hourly develop red. And once this kind of goes over red, that's like a very big confirmation. This is the 1 hour longest period. And boom, there we have it. So obviously that was on a very fast sped up replay speed. So in real time, it's going to look a lot different. They're not just going to be flipping over that clean. There's going to be some shifts in our directions, but this is really why you need kind of all these tools in combination, is because you can make other judgments, not just on the multi-time frames, but you can make judgments on the segment itself. When we turn on our historical stop levels, you can kind of see where price might be attracted to, where it might get rejected, yada yada. We're not going to get into the historical stop levels on this video. We're mainly focusing on the segments and segment related algorithms, because the historical stop level is independent of the market segment shifts, while the multi-time frame segments, as well as the high risk zones and added risk signals, these all use some amount of source code from the market segment shifts, which is modified to do various different tasks, which all these are doing. But the historical stop levels themselves, that is a completely independent algorithm itself, using completely different source code. So once these load back up here, we'll wait, because we're going to move on to the high risk zones and added risk signals. By the way, sometimes these you'll get a little error. It says calculation timed out. When that happens, either just switch the time frame, switch the security you're on, or just switch an input and switch it right back. So if it gives me that, you just do this, that, and then it'll load up. It's tedious, it's annoying. I'm not sure why it gives that error, but it happens. So just be aware of that. It's an easy fix. So now that we're going to be looking at our high risk zones and added risk signals, these are very key, because as I was explaining earlier, we'll get into the high risk zones first. When you're looking at the regression lines and how they're positioned upon a segment shift, these are really meant to visualize that. So what it's doing is we're getting the difference between the middle period and the longest period regression lines. We're getting that difference upon a shift, right? So a bearish shift will have a yellow box, and then a bullish shift will have a blue box. And it's grabbing that shift for the longest period shifts, also as well as the middle period shifts. So you see we have a middle period shift down here, and it's grabbing that difference of the longest and middle period regression lines way up here, obviously because price took a huge tumble right there. So what's really key with these is you're going to want to look for this high risk zone box to be as basically tiny as possible in terms of its width. Because as I was saying, you want to possibly enter trades around shifts and crossovers of these regression lines, right? So when they're crossing over, the difference between them, or when they're close to crossing over, the difference between them will be much smaller. Now, if you were to take this shift here, I'll go into replay mode for that, and we can see what this looks like. Here we go. So now we have these really thick high risk zones, which price never manages to escape from, right? In fact, we go above this. So when you think of these high risk zones, when you're looking at a bearish segment and you're looking to maybe take a short, what you're really going to want to focus on is you want price to be, holding below this zone, right? Price here, you never even get below this zone. In fact, we get way far above it. Not to mention that this zone itself is massive, right? Way too big for any viable actual reversal in trend or change in trend. So with this, I don't recommend this to new users, but once you become very comfortable and knowledgeable, you can look to take little scalps upon things like this, and you can kind of look to scalp this zone. Now I'm not going to get into that. That'll be for a different video and a very specific use case. But for now, just think of these as you want them to be as tiny as possible, and you want price to escape the zone. You do not want it to be within it, or for a short, you don't want to be above it, and for a long, you don't want to be below it. that should be pretty obvious. Now this is an interesting case right here where the zone is very thin, but price is so far off it. So you got to think from just a risk standpoint. If you were going to look to short down here, just using our tools, the next possible kind of tell that you could get, other than our risk signals, which I'll talk about in a second, is if price were to come back up here at these regression lines and be able to make a bullish shift, telling you that, you know, you should probably not be in a short. But this is so far off where price is at. Even though this zone is really small, price is already so far off here. So while this trade would have played out, you have to be aware of that, and you really have to be mindful of your risk if you were to look for an entry on a setup like this. Now, I don't see this occurring all too much. This is a very kind of specific case where there's a huge just drop in price right here, and the regression lines have not caught up to that yet, right? But again, it's something to be mindful of. Now, lastly, we're going to be talking about the high risk or added risk signals. So whenever in a bullish segment, you're going to get a dark blue diamond when risk is added to be in a long, essentially. And for a bearish segment, you're going to get this dark orange diamond. So again, this basically is insinuating that there's an increased risk now to be in a long when the segment is bullish, and there's an increased risk to be in a short when the segment is bearish, and you get one of these signals. So to derive these signals, we're performing a modified analysis similar to the segment shifts, but on an extremely short, fast period. And the reason for this is to get kind of the quickest reaction to small changes in the market, right? So when this occurs, you're not going to be thinking, okay, price is definitely going to be bearish coming off of this signal. But you more want to think of them as possible trim points or exit points if you happen to be in a trade according to one of these segments, right? So depending on your risk and how much downturn you're willing to take on or drawdown, right? You can use these as exits just to properly, exits or trims, just to properly manage your risk, or just to be aware that price might have a slight pullback or retracement to you know, one of these levels here, which are kind of like the various equilibriums for price. And then lastly, I just want to mention this again for clarification. It's in our documentation, but I've seen a few people ask about this. For the multi-time frame segment shifts table, right? This is only accounting for the longest and middle period regression analysis for all these time frames and their segments. It is not accounting for the shortest period. So the way this goes is that the whole left side, this column and this column, right, that is for the long term, the longest term, right, which is the thickest regression line here. Now the right side, the entire right side, these two columns here, that is for the middle period one, right? And then this left, far left column right here, we'll call this column 1. This is for any bullish segment that occurs. And then column 2 right here, this is for any bearish segment that occurs, only for the longest period, right? And then on this side, the far right, right here, is for any bullish segment that occurs on the middle period. And this column right here is for any bearish segment that occurs on the middle period. So I hope that clarifies a lot. And I hope all of you found this video to be useful. We're going to have a lot more videos coming soon on some specific use cases. We're going to be reviewing some specific trade setups. But for the time being, I hope you guys all found this helpful. Thank you very much.